Hi, Jason. Thanks for joining. Hi, everybody. Today, we're joined here by Jason Atkins, the co-founder and president of Cake Equity, and we're talking a little bit about cap table modeling. Now, just a quick disclaimer before we start, you should always seek specific tax or legal advice, so nothing that we say here can be used in your specific situation. Always reach out to someone to get your specific situation assessed to see what's the best application. Now, I think I will introduce you to the lovely speaker of today. His name is Jason Atkins, and he is from Cake Equity. And Jason, would you mind telling the audience a little bit about yourself?
Yeah, hi, thanks for having me. Happy to be here. So yeah, I've been founder of Cake for about 5 years. It's a cap table management system for startups. So modeling is obviously a key component of managing your cap table. Yeah, before that, I have a finance background. I'm an accountant by training, and I worked in a bunch of different financial management roles, including CFO of family offices and helping startups as a CFO, raising capital and stuff like that. So that's where I first discovered equity for startups, and I had a passion for standardizing and simplifying and educating and just making equity a lot easier for everyone. And so that's
So
what
you
I've been
felt the
doing for the
pain?
last. Oh yeah, gosh. I mean, even modeling, like modeling in a spreadsheet, it's never quite works. Like, what happens if I've got a safe and a note? I need to convert my notes, but I don't know my pre-money val. So, look, equity's hard, but we want to make it like 100 times easier. So that's been my mission, and yeah, I'll share as much as I can with you all today on that.
Awesome. And just very briefly going into what Cake Equity is, for those who don't know, there might be one or two people who haven't heard of it. Would you mind just telling us exactly what could they expect from Cake Equity if they were to join?
Yeah, cool. So Cake is Australia's leading solution for managing your cap table. So as a founder, you'll have a wide range of cap table issues. The first one would be, how do I split my founder equity up? And then should I have founder vesting? So right from day one, and then all the way through raising your first round, setting up employee equity or ESOP, as we call it in Australia, modeling, which we're going to talk about today. There's features for modeling. Yeah, so it's a huge product. It's very complex, but we've massively simplified it so that regular humans can use it, like founders and their teams and employees, so yeah, like it's a really cool platform. Save you guys tons of time and money when you're handling your equity.
All right. Thanks, Jason. We're really looking forward to seeing all of the educational things you have to share with us today.
Great, let's get into it. So here we have Cake and Full Stack teaming up to talk about cap table modeling. Tanya will be helping me along the way. So thanks, Tanya.
We can nerd
Accountant.
out together.
Get our nerd on. Yeah. Even though I am an accountant, I'm not very dangerous. I've been doing sales and marketing now for about 10 years. So I think it's great that we have a partnership with Full Stack, because together we can help you get the right outcome. We've already talked about this stuff, but I'm presenting this all over the world in the world's top accelerators, the world's top startups, from Australia to LA and Singapore and beyond. So I think you'll find this is pretty high quality information. Oh, here we go. Accountant joke early on. It's not it's not that kind of modeling. Just so if you were actually after makeup or fashion tips, this is not going to be for you.
Well, we can dress the cap table up a little bit
Oh, nice.
using Cake Equity.
We love a pun at Cake. Well done. Yeah, so we're gonna, like, what is a cap table? First of all, if you don't know what it is, you can't model it. What are some common mistakes that we want to avoid? We're going to run through some examples, like how do you model around, or how do you model your employee equity, just to give you like some really basic run through of how it actually works in practice. Because if don't have a finance or a legal background, or even if you do, it's a 95% chance you've never seen this before. Or if you have seen it once, the second time you go to look at it, you're still like kind of as confused as you were the first time. So we'll run through some examples. Obviously, we'll talk about modeling a capital raise, because that's kind of the most common time we do it. And I think there's a little exercise at the end as well, if we get time. So let's talk about a cap table. What is it? So it's a summary of who owns what in your company's equity. So equity sort of equals ownership. So it's very important for ownership compliance. It's going to include things like, well, it says stocks there. I do this internationally. So in Australia, we call it shares, safes. We're going to talk about what these things all are, I think, in a minute as well. But if you want to go into the jargon, let me know. Notes or convertible notes and options, and sometimes warrants, although warrants are very uncommon in Australia, but they're more common in the US and other countries. So there's lots of different types of equity, and they all together make up your cap table. You can sort of think of it as if you think about it in the most simple form, it's a long list of anyone who owns anything in your company and how many they own and what percentage of the company it is. That's kind of like the simplest way to think about it. It's a big long list. It's very rarely looked at in that way, but that's the one way to think about it. So it's governed by the Articles of Incorporation or the Constitution. So there's like a governing document that you get when you first set up your company, and that, is kind of the rules of how your equity or your cap table can be used. There's specific rules for each company. I don't want to generalize too much, but you could just, if you want to use your cap table, if you want to make new shares or issue a safe round or add a new option plan or whatever, anything you do with your equity, you need to get it approved by your shareholders via a shareholders resolution. So that's something just to be aware of. You can't just go do whatever you want. You need to get the shareholders, sometimes called members, to sign an agreement to say that it's okay to do that. It's super important to keep it up to date and don't mess it up. There's so many reasons why that is. And I guess here's one. The next point, a bad cap table is a red flag for an investor. So
Yes.
if you go and say, hey, give them a spreadsheet, this is what my ownership is. And then they say, well, where are the documents? And you're like, oh,
Yep.
I don't have any.
So
like,
this is what ASIC says, but this is what we're supposed to have it say. They go, no, you don't have your stuff together.
Exactly. The first thing they're going to do in DD is they're going to go to ASIC and they're going to do like a $9 check, or I don't know
Yeah.
how much it costs now.
Yep.
And they check what you've told them and it's not going to match. And they're going to instantly think red flag. And they're going to come back and ask you, and you do have a chance to explain why it's different, but that's not a good look. You want to avoid that. It's harder to get investment if you have differences between ASIC and the spreadsheet and the documents that you provide them. So how is your cap table used? So we are going to get into modeling, but what is it first? So
Yes.
it's to comply with tax and regulatory requirements, as that's one of the most important things. There are obligations on you as a director and shareholder of the company to have your tax and regulatory lodgements done. So for example, with ASIC, you can't just like issue shares and then never update ASIC, so on and so forth. So cap table is important for that aspect. When you want to raise funds and manage your investors, cap table is the central document for that, because you need to show them who currently owns shares. And then after they invest, you need to show them that it's updated so they can see what they own and what percentage it is, and so on and so forth. It's critical.
And also for a new round. So if you're thinking about having a new round, they would want to know, what would my change look like potentially? So how much is this, before I say, yes, let's do another round of XYZ, maybe I want to invest a little bit more to make sure my equity doesn't dilute too much. So very important to manage.
If you can get your existing investors on your cap table to provide more funding, that's option A normally, as long as the terms are good. And then, to see impact of funding decisions. So you can say, hey, like Tanya was saying, what happens if we raise $1 million at a $5 million pre? Or what happens if we raise 200K now at 5 million pre, and then we raise $2 million in 18 months time, or 8 months time, or whatever?
Do you want to explain what pre is, just for those who might not know?
I think we will get into this, but just quickly, when you raise a round, there's 2 valuation points in the round, pre-money and post-money. It is, the first few times I heard it, even as an accountant, I was like, hey, what's this crap? It's quite confusing. So pre-money valuation is the valuation before the money hits the bank, and the post-money is after the money hits the bank. So that's the whole difference. So if you raise at a 4 million pre and you raise 1 million, you'll have 5 million post money valuation. So that's the simplest explanation. When you see some examples later, you'll sort of see how that works in reality as well. It's really important when you're raising a round that you specify in the term sheet or in the communication what the pre-money valuation is and or the post-money valuation, because it can be 20% different. and that can really trip you up. How or why or when? Oh yeah, when we're preparing for a round, we'll do cap table modeling. So that's to quantify the potential dilution of ownership across rounds. So you could be looking at your seed, or I normally advocate looking forward 2 rounds. So if you need to do seed and Series A, what does your cap table look like after those 2 rounds? Because it's really hard to understand where you're going to be unless you do the work.
Yep, and
Yeah.
I often see it where someone goes, I want to raise just a really quick round. I'm going to raise 500,000. I'm going to give them 20%. And they don't realize that when they go to the bigger raise, that your ownership, your 80%, that's going to keep diluting and diluting and diluting, and
Yep.
you're going to end up with very little at the end. So it's very important to plan ahead. I 100% agree with you.
Dilution happens much more quickly than you think. I've
Yep.
experienced this myself, and many founders have. Everything costs more than you think, and it takes longer than you think, and you need more funding than you think, unless you're the one in like 1 in 100 startups gets funded, and then one out of those actually really goes like seed, Series A, and doesn't have rounds in between. So you got to be pretty careful about that kind of thing. Assess. So yeah, like there's multiple funding offers with different terms. So you need to be thinking, is an equity round going to be better than a safe round or a convertible note round, and why? And to be able to model forward, I'm going to get a safe now with a valuation cap and a discount, what that's going to be when it's eventually priced equity versus doing an equity round now. We're going to get into this a little bit. For those of you that are new, that would have sounded like a real mouthful, but what I was comparing there is like an equity priced share round versus a safe round. It's not necessarily priced today, it's priced in the future. If you can't assess those different funding types against each other in a cap table model, you can make very bad decisions, or at least you don't have the information to make smart decisions. So you're kind
Yeah.
of doing it by luck, which is not
You're
a
just
good
looking
idea
at the
when you're dealing
numbers.
with.
Yeah, you're just looking at the money in the bank. Yes, I'm going to have this money in the bank, but how much is that diluting and what's it going to convert at? So
Totally.
I agree with you
And then
100%.
And then you could look at a crowdfund, maybe like, is crowdfunding better? Like sometimes the valuations are better there. Or maybe I could even like get my credit card out for 6 months. I'm not advocating like getting into too much debt, but let's actually look at the different ways to fund the company and compare them
Yep.
and see the impact on your equity and your dilution is really important. So understanding the impacts of convertible debt securities, this is what I just mentioned, safes and notes, they're really tricky and they can create a lot of problems. People make big mistakes with how much equity they're going, how many shares they're going to eventually give away. The biggest risk, which I think we're going to get into, but the biggest risk is that the next round valuation isn't as high as you think it's going to be. And the safe will convert at a discount to that lower valuation in the future. So you think, oh, I've done a safe, it's roughly 20% when I convert, but then when you convert, the valuation's lower and the safe can end up being 30% or more, which is a huge issue, huge problem. So understanding those things, very important. Obviously, you've got your employee option pool to consider. It normally starts off at 10% and increases to 15%. And I think by the time sort of Series B, it's around 18% of your equity is with your ESOP. And so that's obviously a very important thing to be able to model and understand how that's going to impact yourself as founders and all your investors. And then the last one is just understanding share classes and exit scenarios. This is a type of modeling that is not so common at like pre-seed or seed, but becomes really common sort of around Series A, because you're starting to think, what happens if I sell or list the company? You should have some idea on day one, but I think as the company grows, you get more and more sophisticated on this stuff because it becomes more of a bit more likely outcome. What I mean by different share classes, and Tanya, maybe jump in on this because my real accounting is a bit stale, but so at the beginning, everybody has ordinary shares. So the founders will have ordinary shares. And then when you run a round, say a seed round, the lead investor might say, now I want preference shares. And the preference share means it has preference over the ordinary shares. And that preference will normally include things like the investors get their money back before anyone else gets any money. a really bad clause, which I think we're going to get to later, is like, you can end up having to pay the investors 2 or 3 or 4 times their money back before anybody else gets their money, which is the biggest red flag to look for. But normally it's just like they get their money back and they might have anti-dilution and they might have special voting rights and stuff like that. But you just need to be aware each time you run around, the new investors, especially if it's VCs, they get a preference over all the previous investors. So by the time you've run 3 or 4 rounds, you can be in a really bad situation with your own equity. You
Yeah.
can be
And some
diluted.
of what we've also seen is some of the agreements will actually say that no, you are not allowed to issue any further preference shares that are more preferential than the shares I have. And that
I think they
means that,
almost always say that, which then means when
yeah,
you go to do your next round, you have to get your investors to sign off to say that they're happy to
exactly.
sacrifice their preference to the new preference, which is really difficult to get them to do.
Yep. And sometimes that's done for a measly amount of like $30,000 because you're desperate for the money just to get going and you don't know what you get down the track. So I think my piece of advice there is get legal involved 100% and make sure that the different clauses mean.
Yeah, I mean, absolutely. Funding rounds are full of risk. Unfortunately, I've been through
Yep.
many, and every time I look at one of these documents, I want to poke my eyes out because they're so complicated. There's so many clauses that you just can't quite tell exactly what it means and when it's going to kick you
Yep.
in the head, but you know it's going to kick you like if
Yeah.
one of those clauses is going to get you at some point down the track, you're trying to work out which one and how to
Which one's
minimize
the
it.
biggest risk?
Yeah, which one can I negotiate on? Which is also like trying to get multiple offers as well. Like you get 2
Yes.
offers, it might be like they got the same val, but one of them has much nicer terms, and then you would
Yes.
normally always take the offer with the nicer terms. All right, so cap table goals. What are we really trying to achieve? So the first thing is that founders retain maximum ownership. And of course, it needs to be balanced because investors aren't going to invest if you just offer them 1% for 50 million, to give a crazy example. But as long as you're giving good, fair rounds, but you do have to work really hard to protect your equity because everybody wants everybody wants the maximum amount. And so you do have to go into these discussions with a largely combative style while wanting a fair outcome because your equity is gonna go out the door fast. I always say around Series A, if you've got like 50, 60%, you're in really good shape. Because you do 20% dilution for pre-seed, 20% for seed, and you got your ESOP. And so you are going to get diluted. If you can do 10% for your pre-seed, that's better, but it's hard.
Mm.
Quite often you need like a seed plus or a pre-series A as well. So there's normally 2 or 3 rounds before you do series A. So even though the term series A is a little bit defunct, it's more about how much you raise and what you're doing with it. But I guess the whole idea is by the time you're scaling and you're doing 1 or 2 million in revenue and you really know how to scale the business and you're doing like a $3 to $5 million round to really grow the company, you want to be above 50% if you can, is what I would say. There's probably different opinions out there. You want your investors to trust the team. Having full strategic investors is really challenging and can create its own problems, but you want your investors to be like, we trust you, founder, to be the best founder and then be the best CEO you can be, or CRO or COO or CTO, whatever. So they're helping you grow and be powerful, and they see your vision and they're supporting you as much as you can, especially if they can continue to invest. So you might get a couple of hundred on the pre-seed, and then they're really trying to get another million in on the seed or whatever like that. It's amazing. That's the kind of stuff you're really looking for. And or investment introductions to their other investors to build your investor network out over time.
I
And
often
then the
say
team,
investors don't invest in businesses, they invest in founders. So they don't really
yeah.
invest in the business, they 100% invest in the team.
Yeah, I think it's never truer than pre-seed and seed, but it's the same all the way along. I saw Naval, one of Naval's greatest quotes is everybody thinks startups fail because they run out of money, but they fail because founders run out of energy.
Yeah, true.
So,
True.
yeah. So, and look, teams are empowered by their equity, and that starts with the founder as well. So, good investors want founders to have quite a bit of equity because they know it's really demotivating to not. And you want your angel investors and your VCs to be really motivated as well. So if you can increase the value of that equity every year, you're going to get more attention, you're going to get more support, you're going to get them
Yep.
bringing you more investors. And then similarly with your team, if they've got some skin in the game, they've got their ESOP in place, you're going to attract, engage, and retain and grow a great company with your equity. So I've dug into this a little bit already, I think. So founders, sort of 50% plus. That's actually not easy. As I said, it requires efficient cap table management, efficient use of funds. So not only is Full Stack able to help you with this cap table modeling stuff, they can probably help you with financial management. If you don't
Yes.
have quality financial managers in your team, you shouldn't be asking for $1 million or more, because you're probably going to totally waste the money. And I don't mean to be too disrespectful, but you have to have financial acumen to use your money well. Otherwise, you're almost certain to spend it incorrectly and inefficiently and have a lower chance of success. So you have to get a virtual CFO or somebody on your team to help you manage the money well and give you the reporting and the feedback that you need to be successful. Otherwise, you're almost certainly going to need at least one extra round, which is 20% dilution, which you do not want.
Again, that's expensive. It's expensive in
Very
equity and it's
expensive. It's like,
expensive in
yeah, it's like,
time.
oh, I don't want to pay $2,000 a month for a CFO, but the real cost is 20% of your company went out the
Yep,
door because you
that's
wasted.
all.
That's all. Here's an example of a reality. Like, we all want to go seed, like bootstrap, and then go seed, and then go Series A, and like scale off. It'll be $1 billion company. That's what we all want. But trust me, I haven't seen that happen very many times.
Yeah.
And I've seen a lot of this stuff. So it's actually probably more likely that you do pre-seed, and then you do seed, and then you do seed two, and then you do like a top up before your Series A. And I'm not trying to be too facetious, and I don't wish this for you, but like, you got to be aware this can happen and what happens to your cap table. So you start off with 100%, and then you add your ESOP in, and then you do pre-seed and seed and Series A. And so you're already at 48%. And just kind of giving you some visuals about how these things unfold. You can survive with 30 or 40% if that's where you're already heading towards. Like, don't worry, tons of other companies do well. Still, having 20% of a $20 million company that's growing is like amazing, right? It's amazing,
Exactly.
especially if it's your first time at it. Like, for me, I had to raise money on the Gold Coast. There were no investors. And then I had to like pivot. I had to raise another pre-seed round on the Gold Coast. Like, no, I didn't know anyone. And then I went to go, like, I did the hard yards, the first,
Yeah.
like, my first venture, my first rounds, and don't feel bad. Get it done. Do your best. If you don't have 50%, like, just think, oh, wow, I created $2 or $3 or $5 million out of thin air over 3 years. How amazing is that? And I've got a scaling company. So don't be too upset, but we can still have goals, right?
Yep. Yeah. For the next one, right? You have to learn somehow, and then you know what to do or not to do with the next one.
Totally. Absolutely. Second time round. Geez, I'm going to be a lot better. All right. So what are we doing now? Minimizing dilutions. How do we minimize dilution? So as you can see, this hasn't been super technical yet, but I do this on purpose. I want you to understand what a human needs to do to build a company, and we will build some technical bits into this as we go as well. So be awesome with your funding and raise less rounds. We've talked about that. I won't go into it too much. So bootstrap as far as you can with as little money as possible. DIY as much as you possibly can. Side hustle. Learn fast and hit milestones fast. So work backwards. Go and be really, really clear. What milestones do I have to hit to raise a seed round? If you can bootstrap all the way there and hit those milestones and raise your first round as a seed round, you're going to be a whole round ahead, 20% dilution, like ahead, massive. Or pre-seed, maybe it's 50 grand instead of 500 grand. Like, raising capital, 500 grand is a huge time suck as well. So go as far as you can with as little money as possible, hit as many milestones as you can, which sounds obvious, but like, it's not necessarily. So kind of hit that point.
Yeah.
Be super strong with your terms and your valuation. Be creative. Like, the best I've ever seen someone do this was like, her name is Yaz, and she had world's biggest garage sale. It's like pivoted to Sir Economy now. She ran this event where, female founder and like social impact startup. She's like, how am I going to bloody raise capital? So she got all these investors into a room, and they ran this big event, and they had a big presentation. And at the end, she got them all to go up to the back of the room and sign bloody term sheets. It was amazing. So she
There we go.
created this artificial supply and demand and hype, and she got such a big val. And even after a few rounds, she held, like, I obviously can't give all the details away, but she held a massive proportion of her company even after doing 2 or 3 rounds. And so I love hearing stories like that. Be creative, be aggressive.
Be confident. Yes.
Maybe
Trust in your
don't be
product.
aggressive.
Trust in your business. Yeah, not
Yeah,
aggressive.
no, mate, like, don't take it too far that like, my valuation's so high, no one will give me money. Like, there is this balance, like I said earlier, but like, You are the scarcity. If you're really going to have this impact and you're really going to change the world, there's not many of you around and there's a lot of money around. No disrespect to investors. So make sure you get that balance right as much as you can. Have an amazing team with no waste. Like, this is hard. It's one of the mistakes we made. I don't know how I could have done it any better, but like, we had 3 engineers that we had to pay for 2 years to build our MVP. So if you can be leaner, it's like founder, product manager, 1 engineer, 1 designer, like something like that. Ultra small, like lean team that doesn't cost too much.
I often see this with those who have just raised, say, $1 million or so. They go out and hire a marketing manager, for example, but they have no product to market yet. They're not even at MVP stage. So logically, it makes sense because you're hyping up the product, and that sort of feels like the logical next step. But if those leads are not being able to convert into actual users for, say, a SaaS platform or something, what are you doing? What are you spending this amount of money on, this salary for someone who can't do anything?
100%. I think the founders have to solve every problem and can only hire once they've solved the problem, and then they've got half an idea and someone comes in and helps them execute, because you
Correct.
cannot rely, in my opinion, you cannot rely on some random marketing manager that you just hired to work out how your customers are going to pay you money.
Nope.
Like, that's
Nope.
the
Agree.
same as engineering. Hey, engineer, like, here's this job spec in an email, and this thing. I'm not going to get what you asked for. You're
No.
going to get some total mumbo jumbo garbage. Like,
Yep.
this is what you
No
asked
one's in your
for, and then
brain. Yep.
you're going to be in court or like arguing, and then you never, and they say, oh, plus
Yeah.
we own the code, and then you're like,
Yep.
so outsourcing sucks. Has to be done a bit, but like, you got to control everything in the beginning and hire
Yes.
it and slow
Be
it as
vigilant.
minimally as possible. And one other thing that's not necessarily obvious that I learned along the way was being fast at the scalable channels. So you almost always have to do that hacky, slow thing at the start where like founders doing everything. But the quicker you can get to a marketing channel that matches the customer and the ARPU, and just, yeah, finding the right channel for what your business model is going to be able to afford over the long term and getting there really quickly is important, because then you can learn more quickly, which means when you get funding, you can scale more quickly and potentially skip a whole round. I think a lot of the seed 2 round is actually that. So you've got a product, it's in market, you don't get to your channels quick enough. So when you go for the next round, they're going to say you haven't proven you go to market well enough, you haven't learned fast enough, and then you need to do like a bridge round before you can get a Series A done. So it's a big risk.
Yeah.
All right, avoiding cap table red flags. We'll just do this quick because I think we've covered a lot of these. So large holdings with no value add. So like, some people have an accountant or an advisor with like 5 or 10%. Get rid of that immediately. Never a deal with that kind of thing. If you need to know how to deal with that, just look at the Founder Institute Fast. It'll show you exactly how much to give advisors. Founder percentage too low. We've talked about that. No ESOP. Investors don't want to give you money and then you put the ESOP in after, because then they get diluted. So you've got to do the ESOP before you do the round. Broken data and records, we've talked about that. Like, if you say one thing and then you give them another, they're going to assume you're sloppy with everything, like you are with your cap table.
Yeah.
Even though it's pretty bloody hard, and you get a little bit of leeway in the beginning because you're learning, but you don't want to be doing that. Bad terms and side deals. Sometimes angels, like Tanya was saying, oh, some rich guy who's got restaurants and he wants to put money in, but he wants to be an advisor and he wants equity and he wants to get his money back, and he want like, and they're like, no. Like, you need to use like highly standardized agreements, and there's tons out there, and good lawyers and accountants can point you in the right direction. These are built into Cake as well. So if you're using Cake, all the standardized legal agreements are built in, so you won't do any bad side deals. And just having too many investors, which is an annoying one because it's hard to get investors to put big chunks in. But if you've got like 50 little angels on your cap table, it causes you a problem.
Yep.
So now we're on the basics of cap table. What is it? Now we're like, okay, what happens when we look forward? What happens when we think about modeling it into the future? So just like a cash flow forecast, a cap table model is a forecast of your equity. So founders want to see how they're going to dilute into the future, how much they're going to own of the company in the future. Investors want to see that. And then how do you model safes and notes? We've talked about that. And then what happens when we exit? When we sell the company, who gets the money? Because it's not necessarily like just split the whole company up and that's how the money works, because there's that preference stack. I don't think we're going to talk much about that because it's a pretty early stage crew, but just be aware that like the exit cap table modeling is a bit different to what we're going to talk about today. And if you need more information, just let us know. It can sometimes be called waterfall modeling as well if you're looking for it online. Here's the absolute basics of dilution. And for those of you that don't have a finance background, I've never seen this before. This will be like a complicated slide. And for us, the rest of us, it's a bit simple, but I always leave it in here because if you've never seen this before, this is actually a good visual. So,
Eye-opening.
yeah. So Tanya is a founder of a company and she has in the first column there, 30% in the gray box. But if you have a look down the bottom, it's a $4 million pre-company, 5 million post. So they're raising $1 million. So it's 4 pre, 5 post. You own 30%. So of the post money valuation of 5 million, you've got $1.5 million worth of equity. Great. The only other thing to point out is it's totally illiquid. No one in their right mind would ever give you $1.5 million for that. So even though you have that on paper, I wouldn't be running off to the bank for a mortgage against it. So then you go through your rounds and you can see at the top, you got your investors with 20%. That's that 1 million that they just put in. Now, over time, the investor piece gets bigger and bigger and bigger. This feels bad. Trust me, even as a long-term finance professional, it sucks to get diluted in your own company. Along with the dilution come terms that you have to deal with at board level and at shareholder level and just more hoops you have to jump through.
Mm.
But it's important that you get this because if you want to run a company and you want to have investors, you have to get good at this stuff because you can't avoid it. If you want to be a one-man band, that's fine. If you want to bootstrap and own the whole company, that's fine, do that. But if you want to get funding, you have to get across this stuff. So on the right-hand side, Tanya's now got 12% of this company, Series C. And you can see at the bottom, it's an 80 million pre-company with a 20 million round. So it's a $100 million post-money company. Amazing. So even though you've gone from 30% to 12%, which sucks, you've got a $100 million company. So you've got a $12 million asset. And the best thing about this $12 million asset, there's a market for buying equity in $100 million companies.
Yeah.
So then you can go out to some secondary market VC or whoever by then you normally have more investors than you can handle. They're all over you. Trust me.
Yeah.
And everybody wants a piece of the cake and you can go, great, I'm happy to sell 5, 10, 50% of my equity, depending on the circumstance. And you can actually liquidate some of that and buy a house and live a better lifestyle. So this is the concept, I guess, of dilution. It is a bit scary. It doesn't feel good. You have to get comfortable with it. The whole point is, even though you own less, the whole thing's so much bigger, everybody's making money.
Yes. Yes. I often say owning 100% of $1,000 company is a lot different than owning 20% of $100,000 company. So even just on that small scale, it's a huge difference.
Totally. Siri
Thank you,
has something
Siri.
to say. Exactly. All right. So the types of modeling. So you can do modeling a funding round. You can model out converting safes and notes, which we've talked about. You can model out your employee option pool, and you can do exit waterfall modeling. We're going to dig into some of these now. I think I'm going to skip this because we've talked about that quite a few times. All right, here's the example. I'm going to hide this little pictures so I can see the whole screen. All right, so this is an example of a seed round with no ESOP, which normally you would have an ESOP. That's why I put.
Sorry, can I
Say
just
that again,
quickly
Tanya?
interrupt? Can I just interrupt very, very briefly? The names that are on the slides, can they stay or should we blur them?
Yeah, they can stay. They're just random. Look at it. Tony
Gotcha.
Stark, Steve Rogers. They're
Yep,
like
just making sure that
heroes or something.
SJW Enterprises isn't an actual
It's
thing.
not.
Okay, perfect.
It's a joke company. Cool.
Love
All
it.
right. So here we go with a working example of a seed round. So we'll start at the top. We have some assumptions. So the pre-money valuation is 6 million. The total number of shares is 2.5 million. So the share price is $2.40, which is 6 million divided by 2.5 million. There's $2 million coming in. So the post-money valuation is 8 million. You can see there's a small rounding error there. That's not uncommon with modeling because there's just so many numbers and they don't always add up to the exact cent, which is amazing, especially when you've got software that doesn't allow exceptions like we do at Cake. It causes all sorts of headaches, but we've solved that, don't worry. All right, and then the next thing is like the summary of the cap table pre, which you always need to know. What does the cap table look like before the round? And in this case, the founders own all the shares. They own 100%. Cool, that's obvious. After the round, founders go down to 75% on the right-hand side, and the angels own 25%. That's because they put in $2 million of an $8 million company. Does that make sense? Yeah, a quarter. Perfect. Everybody following the maths? Pretty simple. Just go down,
Math
look
is
at it a little
mathing.
bit more. Maths mathing, good. Now a little bit more detail down below. So the top is the summary, and the bottom bit is exactly the same totals, but with more detail, just so you can understand it at the granular level. So in green there, we have John and Susan and David. They're the founders. They own the original 2.5 million shares, and you can see it's 40%, 40%, 20%. And then you go across to the next section where the angel investment comes in. You can see the $2 million, 833,000 new common stock. So it wasn't preference stock in this case, but it could be. But in this case, it was common stock. So we all been the same. Everyone's got the same terms. And then you can see on the right-hand side that the founders have been diluted, say from 40% to 30% and from 20% to 15%. And you got the new percentage allocation for the angel investors coming in. So this is a very, very simple version of modeling a seed round. So let's have a look at the next example. This one does include an ESOP, so it'll be very similar. You've got, yeah, the first section is the same. The second section is slightly different because you've got 13.3% of the company with your team. And that doesn't mean that it's all allocated to the team at that point. Normally, that just means you've created the pool. And just to be clear, in Australia, we don't have a separate entity for the pool or anything like that. There's no sub-trust or anything weird. It just means that you've signed a resolution. It says this number of options has been created for an option pool. It's reserved. And then separately, you would start granting them to the team. So just, I won't get into that too much, but, and then on the right-hand side, you can see the angel investment coming in. It's the same amount. It's the same post-money company. So the founders have got 65, the employees have got 10, and the angels have got 25. So you can see there that the founders have a bit less. They had 75 in this example. Now they've got 65. And you can also see that the angels weren't diluted because their money came in after the ESOP. So they had 25 in this example and 25 in this example, which is why investors always want you to have the ESOP in place before they put their money in. And then the bottom is very similar, except in this case, you've got your 4 employees with common options. In this case, looks like the whole ESOP was granted, but it doesn't always have to be that way. You've got your 4 employees there, and you can see that the founders and the employees are all diluted. And then you get the new investment coming in at the bottom on the right. So I think that's quite clear, just to give you a couple of examples of how to model out a seed round. Now we're going to add a little bit more complexity, but just think about it as like another story on the house. You know, we did like the first floor is like ESOP, no, modeling one round with no ESOP. Then we added ESOP, a little bit more complexity. Now we're adding another round, a little bit more complexity, but it's very, very simple extension to the same principles. So in this case, the numbers have changed a bit, but the principles are going to be the same. So let's go through it all so we can talk through it all again and get a bit of a feel for it. So at the top, we've got the assumptions. So it's a pre-money $18 million company. There's 3.8 and change million shares on issue. It's $4.68 share price. We're raising 5 million. So post-money valuation of 23 million. We go across to the next. So we obviously have to have a summary of the cap table before the round. So we've got founders and employees for a total of 100%. Oh yeah. So this actually models out 2 rounds. That's right. So that's before the first round. And then after the first round of funding, we're adding in the angels for 25% at the top. And then on the right-hand side at the top, we're adding in the next round as well for another 21.7%. So you can see each time you get more money, you create new shares and you dilute the existing investors and add a percentage to the new money coming in. And then going through it in a little bit more detail, similar to the last example, you've got your 3 founders and you've got your employees. They own everything in the beginning, 100%, at the bottom of the fully diluted column. Then you're adding in your first round, which is 2 million, and that dilutes the founders and the employees. And then at the bottom on the right, you've got the 2 seed investors coming in, which they're putting in 5 million, which is a big seed round, but that's cool. Maybe it's an AI startup and they're getting their equity and everybody's getting diluted. So again, quite a simple thing to talk through. But for those of you that haven't seen this many times, I'm sure it's nice to see that a few times with a few examples just to bed down those principles. I'm not going to go through this one in detail, but this is like just talking it through all the way from the start, all the way through. So in this case, you've got the beginning, and then you've got your pre-seed, and then you've got your seed, and then you've got your Series A, and it just builds up. One thing that could happen along the way that doesn't happen in this example is you could have an increase in your ESOP. Probably in this case, you've got your ESOP happening right at the start and then no more employee equity. That's probably not how it's going to happen in reality. You're probably going to see equity being issued to employees at Angel and at Seed and at Series A as you're building your team. But in this example, that's not there. But if you were doing that, you would see those additions happening along the way as well. What can also happen is that your original ESOP allocation of 10% can run out around Series A because you've spent all the options hiring advisors and sweat equity and all your first team members. And then if that does happen, you can increase the size of the ESOP. And you would see that in this model as well and how it dilutes everybody. So that's kind of what we're going to talk about now, managing your options budget. So here's a simple few points and an example. So yeah, it's a good idea to increase the option pool right before your round. So whether that's putting your first ESOP in place before your pre-seed round or increasing the size of the option pool just before your Series A. That's normally a point where you've got very few options left in your original pool. And when you look forward and say, hey, like with my Series A, I need to hire like 5, 10, 20 people. They're all going to want equity. Oh, geez, I'm going to run out. You need to calculate that, increase the size of the pool, and then raise your round. So the key question you're sort of asking when you're looking, is my option pool big enough, is how many people are we hiring in the next 18 months? And that could include, when you're really early, that would include advisors and sweat equity, and then all the first few team members that you're hiring. As you get bigger, it's probably not sweat equity. It could be definitely a little bit for your advisors, but it becomes a really small amount. It's more about people want to earn options on top of their salary to work in a startup. It's super common. So you just need to calculate that. It needs to be built into your salary and remuneration policy. I could talk a little bit about that. Every company is different. I don't want to tell you exactly what to do, but the normal principles are things like my base salary is 100K. Look on the right-hand side here. So just say your product owner might be on 100K base. They could be getting some sort of short-term cash bonus, but then what's their equity allocation? So in this case, because they're a senior role, they're getting 20% on top of their base, which is 20K per year. And how many options is that? You have to calculate that based on the share price, and then you can grant them their options.
And it often forms part of a negotiation, an early negotiation when you're trying to hire that unicorn. So they're asking for, say, 120,000. You can only afford 100. So you say,
Yeah.
can I give you the other 20 in options? So it becomes a really powerful negotiation tool as well.
Totally. It's essential now. We got a new report out that you can check out around like the state of equity in Australia, and it's almost every startup's issuing it now. So if you're not issuing it, how do you hire good people? And you're competing against enterprise salaries, which are normally higher. So again, how do you get these good people to come and work for you? They want some skin in the game. So I won't get into this. Oh, one other thing you need to bear in mind when you're calculating out the number of options is you're normally allocating 4 years worth of options at the one time. So if it's $20,000 a year, you actually need to give them $80,000 worth of options up front, and then they earn it over 4 years. And that's part of the granting process, which we're not going into today. I have other content around ESOPs that you can check out on the Cake website, or just hit me up, hit Tanya up afterwards. We can help with all this stuff. But from a modeling perspective, the things you need to be thinking is make sure the pool's big enough, make sure you're planning for all the hires that you need, make sure that the salary and remuneration policy is good, make sure that you're meeting market expectations and that you're not like under or over offering options, because both are bad. And include your advisors, of course. It's good for your advisors to have a bit of skin in the game, and create a budget for it. Like, all right, I've got 1 million options in my pool. How long is it going to last me? You need to make sure that it's going to last you long enough. you're not going to expend it too quickly and burn your equity, but you're not also going to be like too cheap that you can't use it to attract, engage, and retain a high quality team.
Mm.
So yeah, here's a little example. It's a bit complicated, but I'm going to try and explain this, I guess, as best I can. So I'm going to start at the bottom actually this time. So the first thing you need to work out is your share price, because if you don't know your share price, you don't know how many options to grant. So how you work that out is you get the last company valuation. In this case, it's 10 million. And you calculate the total number of shares and options on issue, which in this case is 111 million. So then you divide 10 million by 111 million, which gives you 9 cents per share. Once you know that, then you go back to the top and you say, well, if you have a look right in the middle, you can see there's a line that says total options. So you put your total number of options in your option pool in there, 11 million. And then you can see you've got your options remaining in the pool. So that's the difference between how many you've granted or how many you've planned and the total pool size. So you can try and work out how to spend it wisely. And I have a spreadsheet version of this if you want it. Maybe we can give it out as a link for people to use. And then you just start planning out your roles. Like, who are they? What role? What's the cost? How much do they get? Is it 5 or 10 or 20% on top of their base in options based on your remuneration policy? And then you get the annual options. You obviously then need to turn that into 3 or 4 year offer. So you multiply it by 3 or 4, and then you divide it by the share price to work out how many options you give. And then, of course, you got to go and do the option offer letter and everything, which will be in cake. So that's just a bit of an idea to model that out.
From a tax perspective, I would just also like to mention that when you are a startup and you do meet certain concessional thresholds, then there is a way to have the tax be deferred for those options, and it's just part of the startup concessions that you can potentially apply for. So bear in mind, when you are allocating options, technically that's a tax event, and the employees may be taxed on that in their personal capacity. So just remember to keep their tax position and your tax position, whether or not you qualify. Just keep that in mind when you are issuing options, because it might actually cost them money when they're getting no money.
Just finally, I guess, on issuing equity and modeling, you need to work out how much to give. So Cake has a tool built in, which gives you the benchmarking. So if I'm at seed stage and I'm hiring a product manager, or if I'm Series A and I'm hiring an engineer, what's the range? So that's kind of helpful. Founder Institute have a fast and ease agreements, which give you really good, clear guidance on how much equity to give for sweat equity and for advisors. So those are just things to help you with that. Yeah, this is just something from before. Cool. So that's it for the presentation itself. One thing I thought we could do.
Yeah,
sorry, go on.
go for it. I just wanted to put a little something in there about the options, because as someone who's struggled with managing options, I always recommend using Cake for it. So I just want to put some words to it, if that's okay.
Yeah.
Yep. So we often come across founders who are trying to manage their options, those that have vested, those haven't vested yet, those that have a cliff, in some sort of an Excel spreadsheet, and it is a nightmare. And since Cake has done it, we have never looked back. Each and every client that has an option pool, we will not even entertain the option of having your options in Excel. You keep them in Cake because it manages it all for you, tells you when what needs to vest. And I think what you've done there is exemplary. So well done.
Thank you so much. I would like to give people a quick demo, not to be overly salesy, but just to give them a real world insight into how to manage your cap table, what it is in real life, and how modeling works and things like that. It's so valuable to see it in that format. So I'm just going to share my screen, and yeah, it's like every single ESOP I saw for the first 4 years of being in startups was broken. Every single cap table was broken without fail. And it's almost impossible to manage it without a solution like Cake. I truly, truly believe that. And yeah, so let's talk a little bit about why that is. All right. So let's talk about options, we'll view a pool that's got some issuance in it here. So this is one where actually has multiple countries. Most of you won't have that, but you can have lots of different countries in Cake. So just say you want to go and add a new offer. You go in here and you add the option holder name. I'm not in there. Let's just look through one of these offers. So here you have the vesting schedule, all visualized. You can access the plan rules. So as a company managing it, you have contracts in the one place, you have all your offers in the one place. The vesting, so here you can see these are waiting to complete, these are waiting to sign, these ones are vesting ongoing. Like imagine you had to manage all these contracts and all these offers and the cliff and the vesting all manually. It's impossible. You have people go and leave and you need to pause. How do you manage that? Then you have people that want to exercise. How do you manage that? You got no idea. Whereas in here, you just come in here and you go, oh, I need to vest some options. Or you go, okay, I'm reverting. Where am I exercising? Here we go, fully vested. Right? And then you can exercise the options and turn them into shares. There's just so many little things that you need to do with an ESOP that doing them manually in a spreadsheet is a nightmare. And then just because this was a modeling tool session, I want to show you the modeling tool. So let's say for argument's sake, we're modeling our safe round. And like in that example, it's a $6 million pre-money and we're raising 2 million. It's 8 million post. It automatically calculates the share price. You can choose pre-money or post-money. You can top up the option pool if you want. You can top it up pre or post, and it'll automatically show you the dilution of every investor down here. You can even change the round type from safe to equity. You can save that and then come back to it later. And then you can also model multiple rounds. So, right, just say I want to do my safe round and then I want to do my seed. It'd be a big seed, but just say like at the seed, we want to have 15 million pre and we want to raise 4 million. You know, it'll show you through all that dilution and it does all the calculations for you. You can download it, you can share it, you can save it. It's super, super powerful to be able to do modeling like that. There's tons of stuff that Cake does.
Does Cake allow you to share some sort of a portal with the investors so they can see the models that you've done?
Yeah, I mean, you can give your investors access to come in and check that out. Absolutely. You can download the models and share them that way. Investors and employees do have their own access to the portal, but it wouldn't normally include the modeling because that's more like a company management thing and investors don't normally get to see that kind of thing. But if they were like a strategic investor or they're on your board, you just invite them in with view access and get them to either view or edit it with you. Yeah, so it'll handle shares and notes and safes, and there's a capital raising workflow, there's an ESOP workflow, all the contracts are built in, all the calculations are done for you. Your lawyer and your accountant and your investors and employees all have access. So doing all that manually is just hell, honestly. You're just certain to fail and cost yourself a bomb in pain and money down the track. So I really couldn't be more strong with that.
I know that you might be seen as having a biased opinion, but I absolutely second that. Doing that manually is a nightmare compared to how much you pay for something like Cake. You almost have to appoint a full-time person to manage that actively.
I joke that when people choose not to use it, I assume they'll either be back soon or they don't know how to make good decisions. And I know that probably sounds really arrogant or facetious. And I appreciate people they don't want to spend money, but yeah, we spent 5 years building this thing, committing every single day to making this easier for everyone. And we really wanted to make sure we didn't charge too much. And I think 30% of Australian startups are already using it. So hopefully that gives you some insight into the value that we're generating.
Absolutely. I'd like to have just a very quick Q&A, if that's okay, around common mistakes that you see. I know we went through that a little bit earlier, but what's the biggest communication mistake that you see with founders and potential future investors?
Yeah, I mean, the biggest mistake, the most common mistake is just not having it up to date. That's almost every cap table, unfortunately. It's just really hard to keep it up to date. So someone's job has to be to keep it up to date. I think the right mentality to have is pretend like you're always raising. Just
Yeah.
have high quality hygiene for how you run your company. You almost want investors to be able to come in any quarter and do DD on you, and your cap table is not going to be cooked because fixing it, repairing it, going back, building it back up is hard. It takes time. You're highly likely to send it to them with mistakes in it, which they don't need many reasons to not invest. They're really looking hard
Correct.
for why not to invest. It's not the other way around.
So in your opinion, do you see investors being more confident in investing if they know that someone's using something like Cake Equity?
Absolutely. Almost every investor in Australia has used Cake now, if not all of them. They would all have a company in there, I would say, by now. The contracts are trusted.
That's
And
right. So
yeah,
you provide templated contracts for each and every transaction that the platform can process.
exactly. The SAFE agreement's built in, the subscription agreement for an equity round, the resolutions for directors and shareholders and ESOP, all those contracts are provided and they're all trusted. Investors, like if you're in a spreadsheet, they're going to say to you, hey, where's my share certificate? And you're not going to be able to find it. They're going to say, hey, what
Yep.
do I own? What percentage do I own? And you're not going to be able to tell them. And they know that. Whereas if you're with Cake, then you're like, at least I've got some chance that I'm going to be able to access my share certificate on Cake
Correct.
or whatever.
Correct. The number of times that I've had investors say, listen, I invested XYZ, but I still haven't received a share certificate. Can you please investigate what's going on? It just didn't happen. Just wasn't done.
It's so hard. So I'm an
And
accountant. I've been doing this for years. And even with Cake, sometimes I'm like, oh,
did
without it,
I?
I would be dead
Yes.
because
Agree.
you ring your accountant and your accountant's like, oh, let me get back to you. And they're really busy. Like, no offense, I'm not
Yep.
housing you, but they're
We
really
are.
busy, right? And then you ring your lawyer and they're like, I don't know, talk to your accountant. And then that probably costs you a bit of money as well. And then, but you don't
Yes.
know. And you're trying to get back to the investor and you're like, and then you frazzle. Whereas with Cake, you can log in on a Saturday when
Yep.
everyone's at home or on the week doing their thing, and you can be like, bam, I know exactly what everyone owns. I can answer
Yes.
that question immediately. Or I can just say, hey, log into Cake. You don't even have to do any work.
Exactly.
They're like,
Exactly.
hey, do
Exactly.
this
Just
thing. And you're like, just log
nah.
in, dude.
It's there. Get it yourself.
Yeah, it's
No, I love
critical.
it. I
And
love
like
it.
one thing I want to stress is like managing your equity for me is the third hardest thing to do as a founder. The hardest thing to do is find product market fit. The second hardest thing to do is build a great team. The third hardest thing to do, in my opinion, is to manage your equity because you have to
Mm.
do it so many times, so
Yep.
often, repeatedly. And every time you go to use it, it's different to the prior time and it's harder because you've gone to the
Yep.
next round. So it's never ending and constantly changing and super complex, but it's so important because it's the actual ownership record of your company. So I hate
Exactly.
to be
Exactly.
dramatic. I hate to be dramatic, but it is one of the most difficult and important things you have to get right.
Yep. And it's so easy to do it when you've got the right tools. I
It's
can't
much
see a
easier now.
reason why you would try
Much easier
to.
now.
Yeah, I really don't understand why someone would want to try and like not do it through something that was purpose built to do it.
Yeah, I have a sadistic little laugh that I do inside when people say they're doing it themselves. I'm like, cool, cool, cool,
Yeah,
cool.
have
I
fun.
bet, I bet that's
Have
fun.
fun.
Yeah.
Stay away from the knives. It's not
Exactly. It's
it's not
like
fun.
it's like saying, "Oh yeah, I'm not going to use Xero for my accounting. I'm going to do everything. Like I'm going to use cash and like a book, a pen and
Yeah, I'll
paper
just write
to
it.
manage. I'm
Exactly.
just
That's
going
a
to
good
write it all
analogy.
down
It's
and use the
fine. I've
phone.
got a ledger and
I've got a ledger.
I'll write it.
I'm gonna ring my customers up once a week and see if they're going to send me some money in an envelope. Like it's literally like that.
Oh, that's great. That's fantastic. I think that was a good one.
Smashed it. Just trust Full Stack. We really rate Full Stack. They're great partners. They're industry leaders, and we love working with them. We think that great startups need great software like Cake and great advisors like Full Stack, and together you're going to get the best outcome. So yeah, get involved.
That's lovely. Thank you. Thanks for all that information, Jason. That was truly fantastic. I think it was extremely educational, jam-packed with a lot of good tips as well. So we look forward to hearing from everybody in the audience. If you have any questions, you could reach out to myself or Jason. And we'll also keep an eye on the FAQs. Thanks, everybody. See ya.
Thanks.
Bye.